Let's talk about the different ways premiums can be structured in a whole life policy. These variations allow policy owners to tailor the product to their specific needs. Instructor introduces single premium whole life. The first variation is single premium whole life. In this case, the policy owner makes one large lump sum payment up front, and the policy is paid up for life. There's just one premium payment, and then the insured is covered until age 100 or death, whichever comes first. If the insured lives to age 100, most companies will pay out the death benefit to the beneficiary at that point. Instructor discusses the risks and benefits of single premium whole life. Single premium policies can be risky for the policy owner if the insured dies shortly after the payment is made, as they've paid far more premium than they would have under a monthly payment plan. However, if the insured lives a long life, the policy owner ends up paying less overall. Instructor provides an example. Let's say Pearl is 30 years old and wants a whole life policy with a $200 monthly premium. If she's expected to live to age 80, she'll pay $2,400 per year for 50 years, totaling $120,000. The insurer might offer her a single premium option where she pays $60,000 up front and never has to make another payment. Pearl chimes in.
Wow, $60,000 is a lot of money to pay at once. I don't think we have that kind of cash laying around.
Honey, check the bottom of the sock drawer.
That's a common concern, Pearl. Most people opt for the monthly premium payment because it's more affordable, even though they end up paying more in the long run. Instructor explains why insurers offer single premium options. Insurers are willing to offer single premium policies because they can invest the lump sum and earn interest on it. This interest helps offset the fact that they won't be collecting ongoing premiums from the policy owner. The insurer is betting that their investment returns will exceed what they would have collected in monthly premiums over the insured's life. Instructor moves on to level premium whole life. The most common premium variation is level premium whole life, also known as continuous premium or straight life. With this option, the policy owner pays the same premium amount for their entire life or until age 100. Instructor draws a graph with age on the x-axis and a straight horizontal line representing the level premium payments. As you can see, the premiums remain constant throughout the life of the policy. Many clients prefer this option because it offers the lowest possible premium while still providing lifetime coverage. Instructor notes what happens when the insured reaches age 100. If the insured lives to age 100, most insurers will pay out the death benefit to the beneficiary, even though the insured is still alive. At that point, the insured is considered statistically dead, and the policy reaches maturity. Another way of saying this is the policy endows at age 100. Okay, let's move on to another type of premium variation called limited pay. With limited pay, the policy owner pays premiums for a specified period of time or a specified age, and then the policy is paid up. A couple of examples are 30 pay or paid up at age 65. Let's say Pearl wants to pay premiums for 20 years, starting at age 30. She would select the 20 pay option, and her premiums would stop at age 50. Compared to a level premium policy, the limited pay option will have higher premiums, but they'll remain the same for the 20-year payment period. What do you think will happen when we compare the limited pay premium to the level premium? The class responds in unison.
The limited pay premium will be higher.
Exactly. Now, here's another question. After Pearl stops paying premiums at age 50, is she still covered by the insurance? The class responds,
Yes,
she's covered for the rest of her life or until age 100, whichever comes first. That's right. It's similar to paying off a mortgage on a house. Once the mortgage is paid, you own the house free and clear. With limited pay whole life, once the premium paying period ends, the policy is fully paid up and the coverage continues. Insurers offer various limited pay options such as 10 pay, 15 pay, 20 pay, and 30 pay. The shorter the payment period, the higher the premiums will be. Instructor provides an analogy. Think of a long, thin balloon as a person's life expectancy, and the thickness of the balloon represents the premium. If you squeeze the air from the back of the balloon to the front of the balloon gets thicker, just like the premium increases when you compress the payment period. The shorter the payment period, the higher the premiums need to be to compensate for the insurer's risk. There's another type of limited pay that's based on age, rather than a set number of years. Let's say Pearl wants to have all her bills paid off by age 65, except for basic living expenses. She could choose a limited pay to age 65 option, where she pays premiums from age 30 to 65, even though she's covered until age 100. Let's say Pearl is just starting out in her career and has a new family and mortgage. Her disposable income is relatively low. A modified premium policy allows her to pay a lower premium initially, and then after a few years, when her income has increased, the premium jumps up to a higher level. Some insurers treat the policy as term insurance during the initial lower premium period, and then it converts to whole life. Others consider it whole life from the start, but acknowledge that there's no cash value accumulation in the early years. Instructor introduces graded premiums. Graded premium policies are similar to modified premiums, but instead of one jump in price, the premiums increase gradually each year for the first 3 to 5 years, like a set of stairs. After the graded period, the premium reaches a level that remains constant for the rest of the insured's life, or until age 100. The number of steps in the premium increases depends on the insurer. Instructor discusses the trade-offs of modified graded and adjustable premiums. With both modified and graded premiums, the policy owner by design pays less in the early years compared to a level premium policy. With adjustable premium, the policy owner may choose when to pay less. However, in all three instances, they'll end up paying more in the later years to compensate the insurer for the lower initial premiums. These options can make whole life more affordable for those just starting out, but it's important to understand the long-term cost implications. The last variation we'll discuss is called indeterminate or non-guaranteed premiums. With this type of policy, the insurer doesn't guarantee what the premium will be beyond a certain point, usually after the first year or two. Instructor explains the potential benefits and risks. The appeal of indeterminate premiums is that if the insurer has a good year, meaning fewer deaths, lower expenses, and higher investment returns, they can pass those savings on to the policy owner in the form of lower premiums, possibly lower than a level premium option. However, if the insurer experiences a bad year with more claims than expected, higher expenses, or lower investment returns, they can increase the premiums. The premiums can fluctuate over time, but will never exceed a specified maximum outlined in the policy. Indeterminate premium policies are not for everyone. They're better suited for those who are more risk tolerant. If you're risk averse, a level premium policy with guaranteed rates might be a better fit, even though the premiums will be higher. With a level premium, you're paying more upfront, but you have the security of knowing your premiums won't increase, even if the insurer experiences poor financial results. Let's do a quick recap. We've covered single premium, level premium, limited pay, modified, graded, adjustable, and indeterminate premiums. Does anyone have questions about these different premium variations? Great! You are soaking up the knowledge like a sponge. Great job on completing this video. Now it's time to test your comprehension of the concepts we just discussed. This video corresponds to ICAP quiz course number 16. Remember that number. Click the link in the comments section to access the Insurance Class Assistance Program, also known as ICAP. Once you're there, look for quiz course number 16. This quiz will help us see if you truly understand the material and are prepared to move on to the next video. Don't forget ICAP quiz course number 16. Good luck and keep up the great work.